Hi, everyone. We're going to get started in just 1 minute. We're going to let a couple people join. We see quite a few of you joining, and we'll get started, I think. All right. Thank you so much for joining us today. I really appreciate it. This is our first Savvy webinar, the tax calm before the storm. During the webinar, we're going to cover how to leverage tax opportunities that arise, how to decide whether and when to use transfer exemptions, and how to plan for estate tax exemptions expiring in December of 2025. Thanks, James. Just a reminder, if you have any questions, feel free to enter them into the Q&A on below at the bottom of your screen. We'll be taking questions at the end of the webinar, and we're so excited to have you here, and James is prepared to answer as many questions. And then we're going to send out this recording in a couple weeks, and so that way you'll have access to it when it's ready. Great. So I thank you again for joining us. And I want to introduce our speaker, James Bergeron from Naveen. James joined Naveen in 2011 and has over 25 years of experience in financial services and product development. His expertise includes taxation, family wealth planning, advisor management, and investor education. Before Naveen, Jim was a general manager at Ameriprise Personal Trust Services and held roles in financial advisory, product, and services development. James holds a BA from Augsburg University and a JD from Vanderbilt University School of Law. Thank you, James, for joining us today.
Thanks, Ashley. And you know what? It's interesting. Ashley and I were joking a little bit before today's session around the fact that nothing more scintillating and interesting than taxes, right? It's a conversation that everyone just loves to have. We think it's relevant, and certainly I'm biased in that I think it's a very appropriate conversation for us to be having right now, especially as we've moved out of the elections. We know the results. We know that it's been a GOP sweep across all three branches, and that's going to start to queue up what will happen next year as we start to hear more about fiscal policy and what that means in terms of taxes. Taxes matter. At the end of the day, they matter for our portfolios as we're constructing those portfolios. They matter in terms of our wealth management objectives overall. And from just a pure planning standpoint, they give us an opportunity sometimes to combine multiple goals. In fact, today, that's one of the things that I'd like for you to take away. If you take away nothing else, remember these two tenets: timing and layering. By timing, I mean taking advantage of what we know. It might be from a tax rate standpoint. And you'll hear me say today that I think tax rates probably remain lower for longer than what we were anticipating even back a couple of months ago. Timing might mean taking advantage of market opportunities and what that provides. Layering means that we're going to look for opportunities to combine a really good tax result with maybe a result that allows you to fund an area that you have passion around, whether that be a charity or the like. Maybe to wrap into that an opportunity to help family members understand what responsibility around wealth looks like and behaves like through interactions themselves. It's one thing for me to tell, for instance, my son how I think he should act and behave. And as a teenager, we all know how well that goes over when we tell teenagers how they should think. That said, I'm going to give them an opportunity. And we're going to talk a little bit about that today. We'll go through a fair amount, but understand, not meant to be comprehensive. It's meant to give you an idea of what you can do with your advisors, the opportunities that might be out there to begin thinking and discussing, and then maybe putting into play. So with that backdrop, let's get into the conversation. Now, there are a couple of inputs that I think are relevant as we start to think about how tax policy will shape next year. as we get this newly seated Congress sworn in after the first of the year, one of the first things that is going to be in front of them is a discussion around the federal debt ceiling. If you've been paying attention, our federal debt level right now is 35.7 trillion or thereabout, a number that's hard for me to get my arms around. But we also generally have to have a ceiling on the amount of debt that we can incur. In other words, an agreement on how much is in the checkbook. And at the end of the day, that discussion usually revolves around budget. Well, last year, our federal government got together and had a negotiation and discussion around the federal debt ceiling. Not the debt level, but the ceiling, how much we can actually borrow as a nation. And from that, they agreed on this. We can't agree. And so they kicked the can down the road. And there is no current debt ceiling. That agreement comes off in January. And so as a result, House, Senate, and White House all going to get together and start the conversation around a new debt ceiling. And that conversation will entertain the budget conversation. How much we spend and how much we raise at the federal government level when it comes to things like taxes, for instance. Now, that tax conversation is going to have to include a number of provisions from a law put in place in 2017. You might have heard it referred to as the Tax Cut and Jobs Act of 2017. But that Tax Cut and Jobs Act reduced taxes almost across the board. Now, the way it was passed procedurally, by the way, almost all tax legislation now is passed through this procedural process that generally means provisions that might add dollars to the debt level end up having an expiration date attached to them. They expire at some point in the future, and that future is 10 years or less. Well, for that act, many of those provisions that were put in place that lowered taxes roll off, expire at the end of next year. So that's going to be a part and parcel of the conversation. Now, the baseline case for that starts with what were those provisions? And you can see on this slide, maybe a little bit distracting the way that it's put together, but generally speaking, at the end of next year, when these provisions expire, and it's written into the law, when they expire, tax rates go up. Deduction amounts will go down. The estate exemption amount that we'll talk about in a little bit, scheduled to go down. That's written into the law. Now, as a part of that, that law can be changed. And in fact, that's part and parcel to what we likely will see starting in 2025, in the first half of 2025. We heard some of it on the campaign trail, and now President-elect Trump is continuing to talk about things that were important during those conversations, extending permanently all of those provisions that reduced rates, raised deduction amounts, increased the estate exemption, and a number of others. President-elect Trump has talked about extending those permanently. It's talked about reducing the corporate tax rate, imposing taxes on endowments, creating tariffs across the board, and targeted tariffs against certain countries like China, for instance. And then we've heard some discussion around taxation on Social Security benefits and gratuities. Now, a lot of those were campaign discussions. What matters more than the discussions and the politics is the actual policy that gets passed. And that policy starts in the House, starts in the Senate. It's where it's hashed out and negotiated, and then ultimately, if agreed upon, signed into law. And the reason why I point that out, the results of the presidential election usually have a short-term impact on the markets, and we certainly saw that this year. Post-election, we saw a ramp up in the equity markets. Usually that volatility is short-lived, and there's, generally speaking, not a long-term impact on the federal equity markets, at least as it relates to the presidential outcome. Now, what does matter more than that outcome is the policy that's put in place. And certainly with a GOP sweep across the board, our baseline conversations start with what President-elect Trump has espoused during the campaign. That will lead into conversations next year and may lead to a tax bill that gets put in place that maybe extends some of these provisions that we've talked about, maybe keeps rates lower. If we see that happening, we may very well see an impact again on the financial markets themselves. And all I'm showing here is a graphic showing what happened back in 2016 and 2017 when then President Trump enacted legislation through Congress and in partnership with Congress that reduced the rates to their current lower levels. And we saw an impact on those markets going forward. All right. So as we talked about the timing related piece, when it comes to layering, the thing that I want you to keep in mind is this idea of looking for and identifying maybe opportunities to meet multiple wealth management goals. A good income tax result, great. I'm a tax planning attorney by training, as you've already heard. And so from my standpoint, I love the idea of generating good tax results, maybe tax savings. But what I really love is the opportunity to combine that result maybe with some other goals, funding a charity or charitable opportunities that you might have passion around, or combining that, as I said before, maybe with an opportunity to help younger family members understand stewardship and understand it in a way in which they're interacting directly, as opposed to just hearing a parent or a grandparent talk about it. All of this also means that we want to manage risk along the way. So a lot of backdrop. Let's start to get into some of the specifics, some things that you might want to start thinking about as we move through year end. Because even though there is a strong likelihood that we'll see some of these lower tax rate provisions extended beyond the end of next year, when they're currently set to expire, the reason why we're talking about this, even in a context where we'll likely see some extensions, because year-end planning is still important. If rates are going to be lower for longer, that means we might want to start taking advantage of some opportunities. Now, the starting point, and I'm a tax planning attorney, right? You knew it was coming. You knew that I was going to end up showing tax tables. I get it. At the end of the day, a lot of numbers here, and I don't want you to necessarily focus on all of the numbers and columns, but a couple of key concepts. So that 2017 Tax Cut Act that I mentioned, that reduced rates for many of us. All I'm showing in this table is the rates that were in place prior to the passage of that act. And as a part of that, I'm also showing the rates that are currently in place. And so if you're looking at these rates, you can see that in 2017, the federal ordinary income tax rate started at 10%, went all the way up to 39.6%. Right now, those rates are lower almost across the board. Now, it still starts at 10%, but it ranges up to 37%. And I think you probably know that we don't necessarily get taxed at the same rate on all of our income. We have a graduated rate structure. So as your income levels go up, the tax rate goes up. Well, in 2017, tax rates were lowered, and then also at the same time, the brackets themselves were adjusted. They were widened. And in that highlighted line, you can see that I'm showing that what was a 28% tax bracket went down 4 percentage points. And that bracket in 2016 was only about $80,000 wide. And once you cross that, you moved into the next higher bracket. Well, now that bracket is 24%, and the width of that bracket is about $180,000 wide, meaning it takes more income to move to the next higher bracket. Now, that provides some opportunity for us, and especially as we start to think about the strong likelihood that that structure will get extended beyond next year. And so lower for longer tax rates remaining lower means that all things being equal, I might want to continue to defer income where I can. Now, there's a couple of things that go into that, but to the extent that income is flexible enough, maybe deferring it rather than recognizing income in December of this year. If I have the chance to recognize it in January, I don't pay the tax until a year from next April. Time value money means that's beneficial. Now, deferring income, one of those things that we always consider. Tax loss harvesting makes sense. To the extent that you can find losses in a portfolio, utilizing them this year means we get to offset income for this year. And again, same concept, time value of money. Recognizing that loss this year might be worth more to me. Now, as a part of that, asset allocation, risk management discussions always have to be factored in. But generally speaking, lower rates for longer means I might want to continue to look for opportunities to defer income this year, next year, maybe even beyond. Now, the one caveat to that is that in some cases, it might make sense to actually recognize some income early. It's counterproductive or counterintuitive to me as a tax planning attorney, paying a tax before I have to, but there may be other reasons why it makes sense. Perfect example of that, something called a Roth conversion. As you know, an IRA is a tax-deferred account. You put money in, it grows tax-deferred, and it gets taxed when it comes out. And at certain ages, the money gets forced out of those accounts. But when it comes out as taxable. I like the tax-deferred growth, but what I like even more, the opportunity for tax-deferred growth and tax-free distributions. And that's what a Roth IRA provides. Now, as a part of that, our federal government may be slow and frustrating sometimes, but they're not necessarily stupid. And they understand that if they made it easy for us to just put everything into a Roth IRA, that's all people would have, tax deferred and tax-free income. So they put some income limits on how much you can contribute directly to a Roth IRA. But what there isn't a limit on is the amount that you can convert from a regular IRA to a Roth IRA. No income limit whatsoever. The one caveat with that, when you convert, it's considered income in the year in which you convert. For example, so I've got $1,000 in an IRA. I convert that $1,000 to a Roth IRA. This year, I've got $1,000 of extra income. So the only real limitation is how much I can pallet in terms of paying a tax. Now, the reason why I like this is that Roth IRA gives us a few benefits. First, tax-free distributions, as you already heard me talk about. In addition to that, I'm not subject to RMDs with my Roth IRAs. So the money doesn't get forced out to me. I take it when I need it, when it's most beneficial. And when it does come out, again, tax-free. Third benefit, that money can be passed as a legacy asset to my heirs, and they receive the distributions tax-free. Now, they might have a window over which they got to take that money out. In fact, generally speaking, 10 years from the point in which you pass that asset to your heirs. But again, it comes out tax-free. And part of what we see from a planning standpoint is sometimes the recipients of those legacy IRAs are maybe in some of their highest income earning years as well. And that money gets forced out of an IRA, whether it's regular or Roth IRA, over that 10-year window for those inheritees. If it comes out as IRA income, it's taxable to them. Roth, not taxable. And then there are a few other benefits. So I think it makes sense to look at and maybe model some of these conversions. And part of what you can do with your tax advisors and with your investment advisors is start to think about modeling an approach. I don't like a wholesale Roth IRA conversion all at once, but I do like a laddered approach to that. Now, that might provide us some benefits. Again, it's counterintuitive because I might be paying a tax early, but I get all of these other benefits. That tax cost might be worth it for those benefits. Now, when I couple this, as I said, I'm not satisfied in just a really good income tax result. I want to start to couple this maybe with some other opportunities. The standard deduction, as you know, when you put together an income tax return, generally speaking, what we do is add up all of our income and then we subtract our deductions. And you have two different flavors of deductions that you can subtract from income. One, the standard deduction. If you're married and filing a joint return this year, that standard deduction amount is $29,200. It might go up a little bit depending upon your age from there, but right around $30,000. The other flavor is the accumulation of all of your itemized deductions. And as a part of that, understanding that those itemized deductions are usable to the extent that they exceed that standard deduction amount. So if your itemized deductions, what are they? Things like charitable gifts, maybe some of your medical expenses, some of your state and local level taxes. All of those, when added up, if they exceed your standard deduction amount, you use your itemized deductions. Now that provides an opportunity. The first thing to recognize, this chart that I'm showing right now shows the standard deduction amount being elevated starting back in 2017 and then reducing at the end of next year. That's the way the law is written. That 2017 Act increased the standard deduction amount. It's set to expire at the end of next year, and if it does, standard deduction amount goes back down. Now, we do think that there's a strong likelihood that this provision also gets extended beyond the next year. What that provides then is an opportunity for you to start thinking about maybe bunching some of your deductions, those flexible itemized deductions, in a year in which it's most beneficial. Let's say, just purely for example purposes, you're giving $10,000 a year to charity, a charity of your choice, or charities of your choice. Over the course of 3 years, that might be $30,000. If I have the wherewithal, maybe I make that $30,000 charitable transfer this year. And I get $30,000 of charitable income tax deductions. When I add that to all of my other deductions, very likely that I exceed the standard deduction amount, and I just use those itemized deductions this year. And next year, maybe I don't make that charitable gift. And maybe my itemized deductions fall below the standard deduction amount, but as I just said, it's likely that it's going to remain at an elevated level. Now, the other benefit here is that in bunching it into this year, I can offset some of that Roth conversion costs that we talked about before. Some of that extra income can be offset by extra or higher level of deductions. Now, your circumstances are going to dictate this, but this gives you an idea of how we can start to layer some strategies together. If you're already making charitable gifts, maybe it makes sense for us to think about the opportunity to bunch some of those gifts into this year to offset that Roth conversion cost. And in one particular strategy, or at least combination of a couple of strategies, I've turned tax-deferred income into tax-free income, the Roth conversion. I've offset the cost, the tax cost of that conversion with a higher level of income tax deductions this year. And the final piece, and this is where some of that layering comes into place, I could take that $30,000 charitable gift, and rather than parsing it out directly to charities this year, I could put that into something called a donor-advised fund. You can think about a donor-advised fund basically as your charitable warehouse. When you put money in, could be cash, could be marketable securities, pretty flexible. But when you put money in this charitable warehouse, you get the income tax deduction in the year in which you put it in. In our example, maybe $30,000 goes into this charitable warehouse, this donor-advised fund this year. I get a $30,000 income tax deduction, offsetting my Roth conversion cost. The other benefit of a donor-advised fund is that the money doesn't have to come out of that fund in the year in which you put it in. In my example, $30,000 went in. $30,000 doesn't have to come out of that warehouse. It can remain in that warehouse. It can continue to grow. And then each year, I get to make recommendations as to which charities are going to benefit from that warehouse. And this can go on for a number of years, maybe even decades. And all the while, the money is invested in that account. It continues to grow. And you continue to make the recommendations as to which charities are going to receive that money. And here's where the opportunity maybe comes in for family members. So I've got a 15-year-old son, or at least had a 15-year-old son a few years ago. He's now 22. When Joe was 15, we were a little bit worried that he was starting to think about money in a way that a lottery winner does, or a professional athlete, money in, money out. How did I know this? Dad, I can't wait for my birthday. Why, Joe? Because I know I'm going to get a number of checks from family members, including some pretty generous grandparents. I know exactly what I'm going to buy. I appreciate the loving and caring nature of Joe's grandparents, but they're way more generous as grandparents than they ever were as parents. And as a part of that, you might know what I'm talking about. As a part of that, I was worried that this was having an impact on Joe. He was starting to think about money in, money out, a lottery winner, professional athletes, inheritees. This psychology can impact them. And I didn't want Joe launching into a career thinking that. A part of what we wanted to do is to help him start to think about money as a steward, a responsible recipient. And as you heard me say at the outset, we could talk about this in a way in which I just tell him how he should think and behave. But as a part of that, I understand telling him at then age 15 and through teenage years how he should think and feel can be a little bit dicey, at least in terms of outcomes. Rather than that, we set up our donor advised fund in part to be able to provide Joe an opportunity to get engaged directly. We set up the fund, we put money in, and each year we have a conversation as a family. And we give Joe, even starting at age 15, you could start it earlier than that if you wanted, an opportunity to decide which charity or charities might we benefit. And all we ask, Joe, why that charity? Now, through that donor advised fund portal, the opportunity to see what's in the account there and to do research on different charities, Joe is selecting charities that he thought were appropriate based upon what's important to us as a family. And as a part of that, he starts to understand on his own things like expense ratios. He's learning that concept, and he's learning it through this activity directly, starting to set him up well as he launches into a career now post-college. Opportunity to layer strategies. All right, so part of what we talked about to this point, timing and layering, we talked about the tax policy changes that we'll likely see starting to rise to the forefront next year and what that means for some of these expiring tax provisions. Lower for longer on the tax rate side. Talked about how we can start to layer some strategies together, maybe funding charitable causes that you might have passion around using this concept of a donor advised fund, and the opportunity to bring younger family members into the conversation. And by the way, kids, grandkids, the donor advised fund is really flexible and really quite cheap. Great opportunity to start to instill some of those notions. Part of what this also means is that start to think about your income in maybe 3, 4, 5 year increments. Rather than each year its own separate conversation, when you heard me talk about bunching deductions, what I'm doing is looking over the course of maybe 3 years and looking for an opportunity to treat tax years slightly differently. Maybe a higher level of deductions to offset things like a Roth conversion cost. With rates maybe remaining lower for longer, gives us that opportunity. You'll get access to some of the materials that I'm talking about today, including how you might want to think about putting some different strategies together, depending upon where tax rates are going for you. So one thing is the tax rates are affected by the law. What are the current rates and brackets? The other thing is that that tax rate and bracket is impacted by your income. So even though tax rates might remain lower, if your income goes up, meaning money getting forced out of IRAs, for instance, that might increase income and push you into a higher tax bracket. So we want to manage that, and we want to think about those in terms of 3-year increments. Part of the role that your advisors play is thinking about your tax situation and tax exposure as they're building and constructing your investment portfolios. And there are different strategies that might have, for instance, inherent tax advantages. Municipal bonds, for instance, provide an inherent tax advantage. There are different strategies that might make sense when we start to consider their tax impact and then weigh or layer in things like the risk component of it. That's the role of your advisors. And part of the reason why it's important for them to understand what your tax situation might look like is that it helps them to start thinking about that portfolio construction. I'm going to talk about a couple of other things here, and then we'll start to wrap up. But remember those grandparents that I mentioned, Joe's grandparents. Very generous as grandparents for my son. And as a part of that, really do appreciate the fact that they were starting to give him some pretty substantial, in my mind, gifts for birthdays, holidays. Part of what we wanted Joe to also start to think about, in addition to being a steward of wealth, is that we wanted him to start to consider, for instance, the notion of having a plan, a financial plan, and working towards goals. One of the ways of doing that, helping him to start thinking about setting up a retirement account and saving for long-term retirement purposes. Well, guess what? When I talk with my 16-year-old son about taking some of his hard-earned, in his mind, really hard-earned summer income and parking it into a vehicle that will provide him income 45 years from now, that's a bit of a difficult conversation. Probably could guess how Joe would respond to something like that. So rather than that, one of the things that we look for are some opportunities to help encourage him to think long term. And again, this is just an example, but one of the things that we did is that we encouraged those very generous grandparents to maybe give some appreciated stock to Joe as he was earning summer income. And it doesn't have to be summer income, it can be any income, but to the extent that he has earned income, he could take that stock, sell it in his own account. It's taxed at his tax rates, not his grandparents' tax rates. And what's more, the proceeds from that can go directly into his Roth IRA. Great concept. Again, thinking about maybe layering some strategies together, it might be a great way to start to think about taking advantage of some of the appreciation that you've seen in portfolios. Maybe we're doing some year-end giving some of those appreciated assets to younger family members, and then having that money move directly to a Roth IRA. Again, why is that beneficial? We already talked about Roth IRAs, tax deferred, tax-free income. But for Joe, part of what we wanted him to think about is this notion of the power of compounding and compounded growth. And I know that's taking root because we've been doing this for a few years. And last year, one of the things Joe suggested to me as he was going through and reviewing his Roth IRA with our family's advisor, Dad, if I keep this up, I'm going to be a millionaire. I love the thought. I didn't have the heart to tell Joe that $1 million 45 years from now may not mean the same thing as $1 million today, but conceptually, he's getting it through action. This is part of what tax planning provides, is the opportunity to move beyond just tax benefits. All right, I'm going to go through some conversations around the estate tax structures. And then, Ashley, in a minute, I'm going to give you maybe a chance to see if there are other thoughts that I might have missed that you want me to weigh in on, or if we've got some questions. But I do want to talk about the estate tax system, at least at the federal level. Now, that said, there are 13 states. I reside in Minnesota, if you haven't gleaned it from my accent yet. But there are 13 states that have their own state level estate tax. Minnesota's one of them. But there is a federal estate tax. Actually, it's a federal transfer tax, and the tax applies on transfers that you make during your lifetime in the form of a gift or at your death. That's considered an estate transfer. Now, a couple of caveats with that. First of all, at the federal level, the government gives us a minimum amount. They say if you're underneath this amount in terms of your gifts, you don't even have to worry about filing a gift tax return. That number this year, 18,000, goes up to 19,000 next year. And it's per donor, per recipient. What does that mean? Okay, between my spouse and I, we both could give $18,000 to our son, Joe, 36,000 in total, and not even have to worry about paying a gift tax return. And the numbers can ramp up pretty significantly, because if Joe were married, we could give him 36, his spouse 36, if Joe had children, each one of them as well. But once you go beyond that number during your lifetime, you're going to be required to file a gift tax return. Now, it still doesn't mean you're going to pay a tax. In fact, it's only once you cross a certain threshold that you have to pay a tax. What's that threshold? Well, you can see it on screen here. This year, that threshold, $13.61 million. If you're married, each one of you have that amount that you could transfer during your lifetime or at death, not have to worry about paying a gift or estate tax. Now, the reason why you see this bar chart working the way that it does is because the provision that elevated that estate and gift tax exemption amount is set to expire at the end of next year. We do see this as one of those provisions that's likely to get extended. And so as a result, I don't think that there is a rush to do anything. But a couple of pieces to keep in mind. First of all, even though this is a big number, $13.6 million, one thing to keep in mind is that's the accumulation, at least the tax on all of your accumulated wealth at your death. If you pass it during your lifetime, it's the value of what you transfer. But at death, it includes everything. It includes cash, marketable securities, real estate, family business interests that you own if you own life insurance. The death benefit of that life insurance gets included in this calculation. And in some areas of the country, when you start to factor in the escalation in real estate values, you can start to get close to that number. All I would suggest here, not really a sense of urgency. The biggest point that I would make when it comes to estate planning, make sure that you've got your four-corner estate documents updated. If you haven't updated them in the last no more than 5 years, probably time for you to go through and make sure they're still relevant. What are those four-corner documents? A will and or revocable trust. Sometimes we use them interchangeably. Some areas of the country, we see more usage of revocable trusts, sometimes referred to as living trusts, as opposed to wills. But they work essentially the same. And as a part of that, make sure that your beneficiary designations align with how you want your assets disseminated. Second corner, power of attorney for financial purposes. Naming someone to make financial decisions on your behalf should you be incapacitated. Could be short term. Maybe it's an automobile accident and you're incapacitated for a few days, maybe even a week or more. This document gives someone the ability to make financial decisions on your behalf should you be in that position? Markets move, maybe there's a need to make an adjustment. Third corner, power of attorney for medical purposes. Same type of document, but providing the opportunity for someone that you name to make those decisions medically on your behalf if you are incapacitated. Usually for both of these, if you're married, it's the spouse that makes those decisions, and that's who the healthcare team would look to immediately. But if you're both in that event, maybe that accident, and both in that position, who has that opportunity? In the fourth corner, a living will, sometimes called a letter of wishes. Why is this important? It's a document that you put together, not for your benefit, but for your family's benefit. And in that document, it outlines, what do you want done on your behalf if you are in a terminal state? It's incredibly difficult to think about, but making decisions ahead of time about things like hydration, nutrition, pain care, management, all of those things, it's not easy, but it's easier when you're not sitting next to a loved one in a hospice room making those decisions for them. Again, this is a document that I create for my family's benefit. Four corner documents. Once you move in wealth levels to about that $10 million level, it's time for us to start thinking about maybe utilizing some of that exemption amount, but it's only at that level. Beneath that level, four corner documents, make sure they're updated and make sure your beneficiary designations on life insurance, on retirement accounts, all match what you want done within your wills and the transfer of those assets. We've gone through a fair amount. Understand that there's more that goes into this. And even if we're starting to transfer assets during our lifetime, understanding that there's a balance. If I make a gift of an asset, I'm giving away that asset and its basis amount. Easy way to understand that. Let's say I've got $1,000 worth of stock that I bought for $100. If I give it away, I make a $1,000 gift. But the recipient, maybe it's Joe in my case, Joe receives that $1,000 with a $100 basis. If he were to turn around and sell it immediately, he'd have $900 of gain. On the other hand, if I pass that $1,000 through my estate at death, it's taxed again at $1,000 for estate tax purposes, but the basis gets stepped up to that fair market value at the date of my death. So maybe it's that $1,000 level, gets stepped up to that. If Joe turned around and sold it immediately, no gains. There's a balance between lifetime gifts, passing assets through the estate, and that's part of what advisors can help you kind of work through. Talked about an awful lot. I won't go in depth into the fact that different types of trusts behave a little bit differently depending upon the environment. Interest rates that are applicable at certain time periods. We know our interest rate environment is starting to come down. That has some impact on some of the trusts that we might use for planning purposes, charitable trusts, family trusts, and the like. It's part of, again, what your tax and legal advisors can help you think about. But Ashley, we've gone through an awful lot, and I'm sure people are starting to get a little bit tired of hearing my voice drone on. So I'm going to pause here. Do you have any thoughts or things that you want me to delve into a little bit further? Or as we start to maybe see some questions coming in, I'm happy to address those in our remaining time.
Great. Yeah. Thank you, James. It was really great. I loved that you shared a lot of your stories about your son, and we truly appreciated your tax insights. I think you made it a lot more engaging than most people, I'm sure, are used to on a webinar. So thank you.
Okay.
Off our disclosure.
Thanks, Ashley, and cheers, everyone. For disclosure purposes, all of the information today has been obtained from sources believed to be reliable. Its accuracy is not guaranteed, and there is no representation or warranty as to the current accuracy, reliability, or completeness, nor liability for decisions based on such information, and it should not be relied on as such. This report and information is provided for informational and educational purposes only. Although this information contains general tax information, it should not replace a client's consultation with a professional advisor regarding their tax situation. Nuveen is not a tax advisor. This information is not intended to provide legal or tax advice. Clients should consult with their legal and tax advisors regarding their personal circumstances. This report and presentation contains no investment recommendations and should not be construed as specific tax, legal, financial planning, or investment advice. Information was obtained from third-party sources, which we believe to be reliable, but not guaranteed. Tax rates and IRS regulations are subject to change at any time, which could materially affect the information provided herein. Nuveen Securities LLC is a member of FINRA and SIPC. Nuveen LLC provides investment solutions through its investment specialists.
Thanks to everyone who joined us today and who held on through our disclosures. We really appreciate it. I'm very grateful that you all were here to join us for our first Savvy webinar. And thank you to James. Thank you so much. You did a wonderful job, and we're so happy to have you on our webinar.
Thanks, Ashley. Cheers, everyone, again. Bye now.